Question 1. Term life insurance specifics. Which of the following statements accurately describes a characteristic of decreasing term life insurance? A. The death benefit remains constant throughout the term of the policy. B. The premiums decrease as the death benefit decreases over time. C. The death benefit decreases while the premiums remain level throughout the term. D. The policyholder can convert it to a whole life policy without additional underwriting. Answer C. The death benefit decreases while the premiums remain level throughout the term. Explanation: decreasing term life insurance is designed so that the death benefit decreases over the life of the policy, typically in alignment with a decreasing financial obligation such as a mortgage. The premiums for this type of policy usually remain constant during the term. Option A is incorrect as the death benefit does not remain constant. Option B is misleading. While the death benefit decreases, premiums typically do not decrease. Option D is incorrect because not all decreasing term policies have a conversion option, and this is a feature generally associated with level term policies. Question 2. Claims process. During the claims process, which of the following is NOT a common reason for denial of a life insurance claim? A. The insured died due to a pre-existing condition that was not disclosed at the time of application. B. The claim was filed after the policy was lapsed due to non-payment of premiums. C. The beneficiary was found to be the insured's estranged spouse at the time of death. D. The insured's age was misstated in the policy application by the insurer. Answer: C. The beneficiary was found to be the insured's estranged spouse at the time of death. Explanation: while insurance policies generally have clauses regarding beneficiaries, simply having an estranged spouse as the beneficiary does not constitute a valid reason for claim denial. If the spouse was legally designated as the beneficiary at the time of death, they are entitled to the benefits. Option A is a legitimate reason for denial if a pre-existing condition affects the death. Option B is also valid if premiums were not paid. The policy may lapse. Option D could lead to a claim denial if the age discrepancy results in the insured being classified in a higher risk category or if it violates the terms of the policy. Question 3. Scenario-based question. Mr. Thompson has a term life insurance policy with a face value of $500,000 that is set to expire in 2 years. He has recently experienced significant health issues and is concerned about being able to secure new life insurance coverage. What options does Mr. Thompson have regarding his current policy? A. He can renew his current term policy for another term without a new medical exam. B. He can convert his term policy into a whole life insurance policy but must undergo underwriting again. C. He can request a rider to add permanent coverage to his term policy without changing the current terms. D. He can let his policy expire and apply for a new term policy without any limitations. Answer A. He can renew his current term policy for another term without a new medical exam. Explanation: many term life insurance policies include a renewal option that allows the policyholder to renew the policy at the end of the term without a medical exam, although the premiums will likely increase based on the insured's current age. Option B is incorrect because while some term policies allow conversion to permanent coverage, it typically does not require new underwriting, although this may vary by insurer. Option C is misleading. Riders must usually be added at the time of the policy issuance, not later. Option D is incorrect as allowing the policy to expire can complicate obtaining new coverage, especially given Mr. Thompson's recent health issues. Question 4. Policy provisions and options. Which of the following optional provisions in a term life insurance policy allows the policyholder to receive a portion of the death benefit while still alive? A. Waiver of premium. B. Accidental death benefit rider. C. Accelerated death benefit rider. D. Disability waiver of premium. Answer C. The accelerated death benefit rider. Explanation: the accelerated death benefit rider allows policyholders to access a portion of their death benefit while still alive, typically if they are diagnosed with a terminal illness. This provision is crucial for policyholders facing significant medical expenses. Option A, the waiver of premium, allows the policyholder to stop paying premiums due to disability but does not provide any death benefit until death occurs. Option B pertains to additional benefits paid if death results from an accident, and Option D is a provision that waives premiums during a period of disability but also does not provide access to death benefits early. Question 5. Underwriting and risk assessment. In the underwriting process for a term life insurance policy, which of the following factors would NOT typically be considered when classifying an applicant's risk? A. Age and gender. B. Income level. C. Health status and medical history. D. Occupation and avocations. Answer: B. Income level. Explanation: while income level can influence a person's need for life insurance, it is not a direct factor in assessing risk classification in the underwriting process. Underwriters focus on elements that affect mortality risk, such as age, gender, health status, and lifestyle choices like occupation and avocations. Options A, C, and D are all critical components of risk assessment as they directly relate to the likelihood of a claim being made. Question 6. Legal and regulatory framework. Which of the following best describes the purpose of anti-discrimination regulations in underwriting life insurance policies in Washington state? A. To ensure all applicants receive the same premium rates regardless of risk factors. B. To prohibit insurers from considering certain protected characteristics in underwriting decisions. C. To mandate that all life insurance claims be paid within a specified time frame. D. To require all life insurers to offer the same policy options to every applicant. Answer: B. To prohibit insurers from considering certain protected characteristics in underwriting decisions. Explanation: anti-discrimination regulations are designed to ensure that life insurance companies do not use certain protected characteristics like race, gender, and disability in making underwriting decisions. This helps ensure fairness in insurance practices. Option is incorrect because risk factors must be assessed to determine appropriate premium rates. Option C pertains to claims processing rather than underwriting, and option D does not accurately represent regulatory requirements as insurers can offer different policies based on underwriting results. Question 7. Tax implications. Which of the following statements regarding the tax implications of life insurance death benefits is true? A. Death benefits are subject to federal income tax for the beneficiary if the policyholder had any outstanding loans. B. Death benefits are generally tax-free for the beneficiary regardless of the insured's age at death. C. Death benefits are taxable as ordinary income if the policy is converted to a whole life policy. D. Beneficiaries must pay estate tax on the death benefits if the insured's total estate exceeds the federal exemption limit. Answer: B. Death benefits are generally tax-free for the beneficiary regardless of the insured's age at death. Explanation: life insurance death benefits are typically paid out tax-free to beneficiaries under federal tax law, which means they do not incur income tax liability. Option is incorrect because while outstanding loans can affect the net amount the beneficiary receives, they do not generally subject the death benefit to income tax. Option C is incorrect. Converting to a whole life policy does not trigger income tax on the death benefit. Option D is misleading. Estate tax applies to the insured's total estate value, not the death benefit per se. However, if the death benefit is included in the estate and the estate exceeds the exemption limit, estate tax may apply. Question 8. Policy management and conversion. When converting a term life insurance policy to a permanent policy, which of the following is usually true? A. The premiums for the permanent policy are based on the age at the time of the original term policy issuance. B. The insured is required to provide evidence of insurability regardless of the original health status. C. The coverage amount of the new policy is generally lower than the original term policy amount. D. The conversion option must be exercised within a specified time frame, typically during the last year of the term. Answer: D. The conversion option must be exercised within a specified time frame, typically during the last year of the term. Explanation: most term life insurance policies provide a conversion option that must be exercised within a specific time frame, often stipulated in the policy, such as within the last year of the term. This allows policyholders to convert to a permanent policy without undergoing additional underwriting. Option A is incorrect. Premiums for the new permanent policy are based on the insured's current age, not the age at the original issuance. Option B is misleading because conversion usually does not require evidence of insurability. Option C is incorrect. Policyholders can often convert to the same or higher coverage amounts depending on the terms of the original policy. Question 9. Fundamental concepts of life insurance. Which of the following best describes the primary purpose of life insurance? A. To provide a savings vehicle for long-term investment growth. B. To ensure financial protection for dependents in the event of the insured's death. C. To accumulate cash value over time that can be borrowed against. D. To cover funeral expenses and other final costs of the insured. Answer: B. To ensure financial protection for dependents in the event of the insured's death. Explanation: the primary purpose of life insurance is to provide financial security for dependents and beneficiaries in the event of the policyholder's death, ensuring that they have the resources to maintain their standard of living. Option A describes a characteristic of some permanent life insurance policies but does not represent the primary purpose of life insurance. Option C is also specific to certain types of permanent insurance, not term insurance. Option D, while partially true, is too narrow and does not encompass the broader goal of protecting the insured's family's financial future. Question 10. Practical applications and case studies. MS. Garcia is considering purchasing a term life insurance policy. She is a 35-year-old single mother of 2 young children. She has recently taken a job with a higher salary but has significant student loan debt and a mortgage. In evaluating her needs, what should MS. Garcia prioritize when selecting her term life insurance coverage? A. The lowest premium available on the market to minimize expenses. B. Coverage that equals at least 10 times her annual income to provide adequate financial support for her children. C. A policy that has a conversion option to whole life insurance in the future. D. A policy that covers only her mortgage balance to avoid overinsurance. Answer: B. Coverage that equals at least 10 times her annual income to provide adequate financial support for her children. Explanation: MS. Garcia should prioritize selecting a coverage amount that will adequately support her children's needs in her absence. A common guideline is to purchase a death benefit that is 10 to 15 times her annual income, providing financial stability for her dependents to cover living expenses, education, and debts. Option A is not advisable as the lowest premium may not provide adequate coverage. Option C is beneficial but should not be the primary focus if it compromises the amount of coverage needed. Option D is too narrow. While covering the mortgage is important, it does not provide comprehensive financial protection for her children. Question 11. Term life insurance specifics. Which of the following best differentiates a decreasing term life insurance policy from a level term life insurance policy? A. Decreasing term policies have fixed premiums, while level term policies have premiums that increase over time. B. Decreasing term policies provide a death benefit that reduces over time, while level term policies maintain the same death benefit throughout the term. C. Decreasing term policies can only be converted to permanent policies, while level term policies cannot. D. Level term policies are typically more expensive than decreasing term policies due to their fixed death benefits. Answer: B. Decreasing term policies provide a death benefit that reduces over time, while level term policies maintain the same death benefit throughout the term. Explanation: Decreasing term life insurance policies are designed such that the death benefit decreases over the life of the policy, typically to match the decreasing financial obligations such as a mortgage. In contrast, level term insurance maintains a consistent death benefit throughout the term of the policy. Option A is incorrect. Level term policies have fixed premiums, while decreasing term policies often have low premiums. Option C is not true. Both types can often be converted depending on the policy terms. Option D is generally inaccurate, as the cost of level term policies can vary based on several factors, including the insurer's underwriting guidelines. Question 12. Claims process. What is the primary reason for requiring documentation when filing a life insurance claim? A. To determine the financial status of the beneficiaries. B. To confirm the cause of death and the validity of the claim. C. To ensure that the policyholder has not changed their beneficiaries recently. D. To provide an opportunity for the insurer to investigate potential fraud. Answer: B. To confirm the cause of death and the validity of the claim. Explanation: The primary purpose of requiring documentation such as a death certificate is to verify the cause of death and ensure that it falls within the terms of the policy, e.g., not excluded due to suicide, within the contestability period. While investigating fraud, option D is a consideration. The primary reason remains validating the claim. Option A is incorrect, as the focus is on the insured's death rather than the beneficiary's financial status. Option C does not pertain to the standard claim process, as beneficiary changes are not the focus during the claims assessment. Question 13. Tax implications. In the event that a term life insurance policyholder takes a loan against the policy's cash value, which of the following statements is true? Regarding tax implications: A. The loan amount is taxable as income if it exceeds the premiums paid into the policy. B. The outstanding loan amount reduces the death benefit payable to the beneficiaries. C. The loan amount is always tax-free regardless of the policy's status. D. Loans taken against the cash value are considered taxable income at the time of withdrawal. Answer B. The outstanding loan amount reduces the death benefit payable to the beneficiaries. Explanation: when a policyholder takes a loan against the cash value of a permanent life insurance policy, the outstanding loan amount is deducted from the death benefit payable to the beneficiaries upon the policyholder's death. Option is incorrect. Loans are not taxable as income unless the policy lapses or is surrendered. Option C is misleading, as while loans are typically not taxable, the death benefit is reduced by the outstanding loan amount. Option D is incorrect. The loans are not treated as taxable income unless the policy is surrendered. Question 14. Underwriting and risk assessment. In evaluating an applicant for a term life insurance policy, which of the following factors would most likely lead to a higher premium? A. A family history of chronic diseases. B. Engaging in a physically demanding job. C. A history of smoking. D. Being in excellent health. Answer: C. A history of smoking. Explanation: a history of smoking is a significant risk factor that typically results in higher premiums due to the associated health risks and shorter life expectancy, while A and B are also factors that may lead to increased premiums. The impact of smoking is more pronounced in underwriting decisions. Option D would generally lead to lower premiums since excellent health is associated with reduced mortality risk. Question 15. Policy management and conversion. Which of the following is not typically a benefit of converting a term life insurance policy to a permanent life insurance policy? A. The policyholder can obtain a death benefit regardless of health changes. B. The policyholder may accumulate cash value in the new permanent policy. C. The premium for the new policy will always be lower than that of the term policy. D. The coverage can last for the policyholder's entire life. Answer: C. The premium for the new policy will always be lower than that of the term policy. Explanation: converting a term policy to a permanent policy does not guarantee lower premiums. In fact, premiums for permanent insurance are usually higher due to the lifetime coverage and potential cash value accumulation. Option is correct, as conversion allows for coverage despite health changes. Option B is true since permanent policies often build cash value. Option D is also correct. Permanent policies typically provide lifetime coverage. Question 16. Legal and regulatory framework. Under Washington state law, which of the following is true regarding the licensing requirements for life insurance agents? A. Agents must complete a minimum of 20 hours of continuing education every year to maintain their license. B. Agents are exempt from licensing requirements if they only sell term life insurance policies. C. A life insurance agent must pass a written examination to obtain their license. D. Licensing requirements vary significantly by insurance company. Answer: C. The life insurance agent must pass a written examination to obtain their license. Explanation: in Washington state, individuals must pass a written examination to obtain a life insurance license, demonstrating their knowledge of insurance products and regulations. Option A is incorrect. Continuing education requirements may vary, but are typically not that high for every year. Option B is misleading. All life insurance agents must be licensed regardless of the type of insurance they sell. Option D is inaccurate, as licensing requirements are set by state law, not determined by individual insurance companies. Question 17. Problem solving and critical thinking. Mr. Thompson has a term life insurance policy with a face value of $500,000. He is considering whether to purchase an accidental death benefit rider for an additional premium. What should Mr. Thompson consider when deciding if this rider is necessary? A. His current health status and the likelihood of accidental death. B. The cost of the rider compared to the total premiums paid for the policy. C. The total amount of his other life insurance coverage. D. The specific exclusions related to the rider. Answer A. His current health status and the likelihood of accidental death. Explanation: when considering an accidental death benefit rider, Mr. Thompson should evaluate his personal risk factors, such as health and lifestyle, that could affect the likelihood of accidental death. If he believes his risk is low, the rider may not be necessary. Option B is relevant but secondary, but the cost should be considered in the context of his risk assessment. Option C is less critical, as the focus should be on the risk of accidental death relative to his current coverage. Option D is also important, however, understanding his risk profile should come first before reviewing specific exclusions. Question 18. Fundamental concepts of life insurance. Which of the following best describes the concept of face value in a life insurance policy? A. The total amount of premiums paid by the policyholder over the life of the policy. B. The amount of the death benefit that the insurance company will pay to beneficiaries upon the insured's death. C. The cash value available to the policyholder if they decide to surrender the policy. D. The value assigned to the policy by the insurance company for underwriting purposes. Answer: B. The amount of the death benefit that the insurance company will pay to beneficiaries upon the insured's death. Explanation: the face value of a life insurance policy is the predetermined amount that the insurance company agrees to pay the beneficiaries upon the insured's death, assuming all premiums are paid. Option A refers to cumulative premiums, not the policy's death benefit. Option C pertains to cash value in permanent policies, not term life insurance. Option D is not an accurate definition of face value. It does not account for underwriting considerations. Question 19. Term life insurance specifics. What is the primary purpose of a conversion privilege in a term life insurance policy? A. To allow the policyholder to add additional coverage for accidental death. B. To enable the policyholder to extend the term of their current policy without additional underwriting. C. To provide the option to change to a permanent life insurance policy without proof of insurability. D. To allow the policyholder to reduce their coverage amount during the term. Answer: C. To provide the option to change to a permanent life insurance policy without proof of insurability. Explanation: the conversion privilege allows the policyholder to convert their term life insurance policy to a permanent policy without undergoing additional medical underwriting, which can be advantageous if the policyholder's health deteriorates. Option A is incorrect. The conversion does not inherently add accidental death coverage. Option B is misleading, or the conversion does not extend the term but changes the policy type. Option D is not typically associated with the conversion feature of term policies. Question 20. Claims process. What is the purpose of the contestability period in a life insurance policy? A. To allow the insurer to change the terms of the policy after it has been issued. B. To provide the policyholder with the opportunity to review the policy before it becomes active. C. To limit the insurer's liability for claims made within a specified period after the policy is issued. D. To give the policyholder a grace period for late premium payments. Answer: C. To limit the insurer's liability for claims made within a specified period after the policy is issued. Explanation: the contestability period typically lasts for the first 2 years of the policy and allows the insurer to investigate and deny claims based on misrepresentation or fraud in the application process. This period protects insurers from claims shortly after the policy is issued, during which they can ensure the validity of the policy. Option is incorrect, that the terms of the policy cannot be changed unilaterally by the insurer. Option B is not the purpose of the contestability period. A policy review is a separate process. Option D refers to grace periods related to premium payments, which are not related to contestability. Question 21. Fundamental concepts of life insurance. Which of the following best describes the concept of insurable interest in life insurance? A. The insured must have a financial stake in the insured's life. B. The beneficiary must have an interest in the death benefit of the policy. C. The policyholder must be a family member of the insured. D. The insurer must have a legal right to issue the policy. Correct answer: A. The insured must have a financial stake in the insured's life. Explanation: insurable interest is a foundational principle in life insurance, requiring that the policyholder have a legitimate financial interest in the continued life of the insured. This means the policyholder would suffer financial loss upon the insured's death, ensuring that life insurance cannot be used for wagering purposes. Option B refers to the beneficiary's interest, which is relevant but not the primary definition of insurable interest. Options C and D are incorrect, as they do not accurately capture the insurable interest requirement. Question 22. Policy provisions and options. What is a waiver of premium rider? A feature that allows the insured to receive benefits without paying premiums if disabled. B. A provision that allows the insurer to reduce premiums for a certain period. C. A benefit that pays out in case of accidental death only. D. An option to increase coverage without medical underwriting. Answer: A. A feature that allows the insured to receive benefits without paying premiums if disabled. Explanation: a waiver of premium rider ensures that if the policyholder becomes disabled and unable to work, they will not have to pay premiums while receiving the benefits. This rider enhances the value of a term life insurance policy by ensuring continued coverage despite the inability to pay due to disability. Option B incorrectly describes a temporary reduction, while option C pertains to accidental death benefits specifically, and option D relates to conversion options, not waiver of premium. Question 23. Legal and regulatory framework. In Washington state, what is a requirement for agents selling life insurance? A. They must have at least 3 years of experience in financial services. B. They must complete a state-approved training course and obtain a license. C. They are required to sell only term life insurance. D. They must undergo a criminal background check only after complaint. Answer. B. They must complete a state-approved training course and obtain a license. Explanation. In Washington, insurance agents are required to complete state-approved training and pass a licensing examination to ensure they understand the products they sell and comply with state regulations. This protects consumers and ensures that agents are knowledgeable. Option is incorrect because experience is not a statutory requirement. Option C is false, as agents can sell various types of life insurance. Option D is misleading. Background checks are typically required before licensing, not just after complaint. Question 24. Claims process. Which of the following is a common reason for claim denial in a life insurance policy? A. The insured's premium payments were made late. B. The policyholder provided inaccurate information during underwriting. C. The claim was submitted more than 30 days after the insured's death. D. The policy was converted from term to whole life. Answer. B. The policyholder provided inaccurate information during underwriting. Explanation. Claims may be denied if the insurer discovers that the policyholder provided false or misleading information during the application process, especially concerning health and lifestyle, as this can constitute misrepresentation. Option is incorrect because late payments usually lead to a grace period, not immediate denial of claims. Option C is misleading, as the time limit for submitting claims varies by state and policy terms. Option D is irrelevant to claim denial. Conversion itself does not lead to denial unless other conditions are not met. Question 25. Underwriting and risk assessment. What is it? Preferred risk classification. A. A classification for individuals who are less likely to file claims. B. A classification for individuals who are likely to have a higher than average mortality risk. C. A classification that guarantees low premiums regardless of health. D. A classification for individuals with significant pre-existing health conditions. Answer A. A classification for individuals who are less likely to file claims. Explanation. Preferred risk classification is assigned to applicants who are deemed to have a low risk of death, typically resulting in low premiums due to healthier lifestyles and better health histories. Option B is incorrect. Preferred risks are the opposite of higher risk. Option C misrepresents the nature of preferred classifications, while option D pertains to substandard risks, which typically have higher premiums due to health issues. Question 26. Tax implications. What is the tax treatment of death benefits received by beneficiaries under a term life insurance policy? A. Taxable as ordinary income. B. Tax-free up to $1 million. C. Tax-free to the beneficiary regardless of the amount. D. Is subject to estate tax only. Answer. C. Tax-free to the beneficiary regardless of the amount. Explanation. Death benefits from a life insurance policy are generally received by beneficiaries tax-free, providing financial security without additional tax burdens. This is a crucial aspect of life insurance and one of its primary advantages. Option A is incorrect because these benefits are not taxed as ordinary income. Option B is misleading and there is no cap on the tax-free amount. Option D is inaccurate, as death benefits are typically not subject to income tax, although they may impact estate taxes depending on the overall estate value. Question 27. Term life insurance specifics. What is a characteristic of a decreasing term life insurance policy? A. The face value remains the same throughout the term. B. The premiums typically decrease over time. C. The face value decreases while premiums generally remain level. D. The policy can only be converted to whole life insurance. Answer. C. The face value decreases while premiums generally remain level. Explanation. In a decreasing term policy, the face value decreases over the term of the policy, often corresponding to a declining debt or financial obligation, such as a mortgage. However, the premiums usually remain constant. Option A is incorrect because the face value changes. Option B is misleading, and while premiums can change, they often stay the same. Option D is false. A decreasing term policies can vary in terms of conversion options. Question 20. Policy management and conversion. When a term life insurance policy is converted to a permanent policy, what is typically required? A. The insured must pay a higher premium than their original term policy. B. The conversion must occur before the policyholder reaches age 65. C. The insured is not required to provide evidence of insurability. D. The policy will not cover any existing health conditions. Answer: C. The insured is not required to provide evidence of insurability. Explanation: many term life insurance policies allow for conversion to permanent insurance without the need for additional health assessments, which is a significant benefit for those whose health may have deteriorated. Option A is correct that premiums often increase, but this is not a requirement for conversion itself. Option B is incorrect as age limits vary by policy. Option D misrepresents the nature of permanent coverage. It does not exclude existing conditions unless specified in the policy terms. Question 29. Problem solving in critical thinking. Mr. Smith is evaluating whether to keep his current term life insurance policy or convert it to a whole life policy. He is 45 years old, in good health, and has a 20-year term policy that he purchased 5 years ago. What factors should Mr. Smith consider before making a decision? A. The increased cost of premiums in a whole life policy versus the remaining term. B. The investment component of a whole life policy compared to term life. C. His current financial obligations and future needs for insurance coverage. D. All of the above. Answer: D. All of the above. Explanation: when deciding whether to convert a policy, Mr. Smith should consider the increased costs of premiums associated with whole life insurance, the potential cash value growth and investment component of whole life policies, and his overall financial obligations, including dependents' future needs. Each factor significantly influences the decision to maintain term insurance or invest in permanent coverage. Thus, all considerations are essential in making an informed choice. Question 30. Emerging trends and challenges. Which of the following is a current trend affecting the life insurance industry? A. Increasing demand for traditional insurance products with no digital components. B. A decline in consumers' interest in purchasing life insurance due to market volatility. C. The rise of insurtech companies offering innovative digital solutions and streamlined processes. D. Decreasing life expectancy leading to a reduction in policy issuance. Answer: C. The rise of insurtech companies offering innovative digital solutions and streamlined processes. Explanation: insurtech refers to the use of technology to enhance insurance processes, including underwriting, claims, and customer service. This trend is reshaping how insurance products are marketed and sold, making life insurance more accessible to consumers. Option is incorrect as consumers increasingly prefer digital solutions. Option B reflects a challenge but does not encompass the overall trend. Option D is misleading and life expectancy is generally increasing, not decreasing, impacting the industry positively.